Hey everyone, and welcome back to the Deep Dive. Today we're digging into something that, well, it might not make the splashiest headlines, compared to big profit news, but it's absolutely essential for any business just to keep the lights on. We're talking about working capital management because you see companies waving profit numbers around, but there's this other less visible engine that really decides if they survive or not. So our mission today, cut through some of that finance jargon. We want to show you the maybe surprising truth about how day-to-day cash flow really steers the ship. It's more than just making money. It's about how managing the everyday stuff, assets, liabilities, that's the real secret to sticking around and actually building wealth.
That really nails it. Working capital, it's not just some line item for accountants. It's genuinely the lifeblood, the circulatory system of a business. And something that gets missed a lot, and we'll definitely get into this, is how many companies that look profitable still end up failing.
Right. How does that even happen?
Well, simply put, they can't pay their immediate bills. They can't meet those short-term obligations. So managing working capital effectively, it's survival, pure and simple, not just about growth.
Okay, let's unpack that then.
Yeah.
Lifeblood sounds dramatic, but probably accurate. Yeah. So what is working capital in plain English?
Okay, simplest terms. It's the difference between a company's short-term assets and its short-term liabilities. Think of it like this. What you own that's easily turned into cash soon, like inventory, money owed by customers.
Right, receivables.
Exactly, receivables. And then you subtract what you owe in the short term, money owed to suppliers, maybe a bank overdraft.
So it's the ready money for day-to-day operations.
Precisely. And it's so central for, well, three big reasons. First, for a lot of businesses, especially manufacturers, these current assets, they make up a huge chunk of their total assets, sometimes the majority. Second, and this is key, what shareholders really value, what drives wealth, is cash generation, much more closely than just the accounting profit number.
So profit's one thing, but actual cash in the bank is another.
You got it. You can report a profit, but if you can't make payroll or pay suppliers because the cash isn't there, you're in trouble, big trouble. And third, maybe the most stark point, a huge number of company failures, collapses, they link directly back to poor working capital control, bad liquidity management. It's often the hidden reason businesses go bust.
Wow. Okay, so that leads us straight into what you mentioned earlier, these sort of twin goals, which sometimes seem to fight each other. Liquidity and profitability. How does that work?
It's a constant balancing act, a real tightrope walk. Let's take liquidity first. That's just about having enough cash or things easily convertible to cash to pay your bills as they come due. Simple concept, but critical.
And if you don't have it?
The consequences can pile up fast. You pay suppliers late, maybe lose discounts. You might lose good employees if payroll is uncertain. Your credit rating gets hammered. And the worst case scenario, not being able to pay debts can force you into compulsory liquidation. Game over.
Ouch. Okay, so that's liquidity. What about the profitability side of this balancing act?
Right. So profitability here means making sure your money is working hard for you. See, funds tied up in working capital, like too much stock sitting in a warehouse or customers taking ages to pay you, that money isn't earning much, if anything.
So holding too much inventory, even if it feels safe, hurts your returns.
Exactly. Excessive working capital drags down the overall return on the money invested in the business. Investors expect a certain return, and having loads of cash sitting idle or piles of slow-moving stock doesn't help achieve that.
I see. And this is where it gets really interesting, that tension. Like you said, holding lots of cash makes you super liquid, super safe in the short term, but it's not earning anything. I remember looking at, say, U.S. Treasury bills back in late 2016, super safe, right? But the yield was tiny, like 0.4% or something. So being too liquid is actually expensive in terms of missed opportunities.
Precisely. That's the trade-off. And while every business wants that perfect sweet spot, that optimal level of working capital, getting there is tough. External factors constantly mess with it. Well, maybe your main supplier is unreliable, so you're forced to hold extra inventory more than you'd like, just as a buffer. That increases your working capital needs, whether it's optimal or not. The real danger lies in the extremes. You've got to avoid them.
Okay, what are the extremes?
On one end, there's overtrading. That's basically running the business with too little working capital for the amount of activity you're doing, sometimes called under-capitalization.
How would you spot that?
A classic sign is relying more and more on short-term borrowing, like overdrafts, compared to your long-term funding. It's like you're constantly scrambling for cash. The other extreme is over-capitalization. Too much working capital. Sounds safer, maybe, but it's inefficient. Money tied up unnecessarily, depressing those returns we talked about.
Got it. So avoiding those extremes, finding that balance, it's critical. How do companies actually measure this stuff? How do they track their working capital health?
Right, you need tools. And the main tools here are financial ratios. They help you diagnose what's going on.
Okay, ratios. Let's dive in. Where do we start?
Let's start with liquidity ratios. These tell you about the company's ability to meet its immediate short-term debts. The most common one everyone knows is the current ratio. That's simply your current assets divided by your current liabilities.
And the rule of thumb is usually something like below 1 is bad and higher is better.
Well, that's a textbook starting point, but it's actually way more nuanced than that. A ratio below 1 can signal problems, yes. But a very high ratio isn't automatically good either. It might mean you're inefficient. And crucially, what's right really depends on the type of business.
Okay. So like a traditional factory making widgets would need a different ratio than, say, a supermarket.
Exactly. Think about that traditional manufacturer. They've got raw materials, stuff being made, work in progress, finished goods waiting to be sold. Plus, they might give customers 30 or 60 days to pay. All that ties up cash. So they often need a current ratio of, say, 2.1 or even higher just to feel comfortable.
But then you look at modern manufacturing, maybe using just-in-time methods.
Right. They aim to keep inventory super low, so their current ratio might naturally be lower. And then you get to the retail giants. Think Tesco, Walmart. Their current ratios can actually be less than 1.
Less than 1? How does that even work? Aren't they technically insolvent on paper then?
It seems like it, but here's the magic. They have immense power over their suppliers. They negotiate really long payment terms, maybe 90 days or more. But they're customers. They pay immediately at the checkout. And their inventory turns over incredibly fast due to slick logistics.
So they collect cash from sales before they even have to pay for the goods.
Essentially, yes. They're effectively using supplier money to fund their operations. It's a very efficient model if you have that kind of market power.
That's quite a business model. Okay, so current ratio depends on the industry. What about the quick ratio? The acid test.
Good question. The quick ratio takes the current ratio idea but makes it stricter. You take current assets but subtract inventory first, then divide by current liabilities.
Why take out inventory?
Because inventory isn't always easy to sell quickly without a big discount, especially if it's specialized or slow-moving stuff. So the quick ratio gives you a sense of whether the company could pay its immediate bills without relying on selling off its stock. It's a tougher test of liquidity.
Makes sense. So those are about immediate ability to pay. What about how efficiently things are moving, how well resources are being managed over time?
That's where efficiency ratios come into play. And often it's clearer to think about these in terms of days rather than just a raw turnover number. It makes it more intuitive.
Okay, days, like how many days something takes.
Exactly. For instance, inventory days. This estimates on average how long your inventory sits around before it gets sold.
And you generally want fewer days, right? Faster turnover.
Generally, yes. Lower inventory days means less cash tied up in stock, less risk of obsolescence. The formula, roughly, is your average inventory divided by the cost of the goods you sold, then times the number of days in the year.
Okay, inventory days. What else?
Then you've got receivables days. This tells you how long, on average, it takes for your customers to pay you after you've made a sale.
And again, lower is better here. Get the cash in quicker.
Usually, yes. You want to collect that cash efficiently. The calculation is similar. Average receivables divided by your credit sales times days in the year. We often just assume all sales are on credit for simplicity here.
Right, so faster inventory turnover, faster customer payments. What about paying our own bills?
Payables days. This estimates the average time you take to pay your suppliers.
And here, higher is better. Holding on to cash longer.
Often, yes. From a pure cash flow perspective, stretching out payments helps your working capital. You're using your supplier's credit. But there's a big but. You have to be careful.
How so?
Well, delaying payment might mean you lose valuable discounts for paying early settlement discounts. Or if you push it too far, you damage your relationship with suppliers.
Yeah, nobody wants to be known as the company that pays late. Bad reputation.
Exactly. Being a good corporate citizen, paying reasonably promptly can be important too. So while longer payables days can be good, it's not always the best strategy overall. The formula is average payables over credit purchases times days.
Okay, inventory, receivables, payables. Any other key efficiency measures?
One more useful one is the sales to working capital ratio. This looks at how much sales revenue you generate for every dollar you have tied up in working capital. That's inventory plus receivables minus payables.
And you want this ratio to be?
Generally, you want it to be rising over time. It suggests you're getting more efficient at using your working capital to drive sales.
Got it. So all these ratios, inventory days, receivables days, payables days, they all feed into something bigger, right?
Yeah.
You mentioned the cash operating cycle.
Yes, absolutely. This is often seen as the ultimate measure. Some call it the working capital cycle or the cash conversion cycle. It pulls those days ratios together.
How does it work?
It's quite elegant, actually. You take your inventory days, add your receivables days, and then subtract your payables days.
Inventory days plus receivables days, payables days. Okay. What does that final number tell us?
It tells you the average number of days that elapse between you paying cash out to your suppliers for inputs and you receiving cash in from your customers for the final sale.
So it's the length of time your cash is actually tied up in the operating cycle of the business.
Precisely. And naturally, the longer that cycle, the more cash, the more resources are locked up in working capital.
So shorter is generally better.
Shorter is definitely desirable, yes. But, and this is important, management's ability to shorten it is often limited by factors outside their direct control.
Such as?
Well, first, the very nature of the business. We talked about supermarkets maybe having a negative cycle, getting cash before they pay suppliers.
Right.
Contrast that with, say, a large construction project or a winemaker. They might have huge amounts of work in progress or aging inventory leading to very long cycles. It's just inherent in what they do.
Industry differences again.
Absolutely. And industry norms matter too. If all your competitors offer customers 60 days to pay and you try to demand payment in 15 days, you might just lose all your business.
So you're constrained by what customers expect.
You are. And similarly, your power relative to your suppliers. If you're a small company dealing with a huge supplier, trying to force them to give you longer payment terms might just result in them saying, okay, fine, cash on delivery from now on.
Ouch. Which would make your payables days 0 and blow out your operating cycle.
Exactly. So while shortening a cycle is the goal, you have to operate within the realities of your industry and your negotiating position.
This is fascinating stuff. It really shows how interconnected everything is. Okay, theory's great, but let's make this real. You mentioned a case study. Topple.
Yes, let's look at Topple. Imagine it's their first year and we have some forecasts.
Okay, lay it on us.
All right. Forecast sales, $3.6 million. Purchases expense, $3 million. Average receivables expected, $306,000. Average inventory, $495,000. Average payables, $230,000. They're also forecasting a pretty significant average bank overdraft of $500,000, and their gross profit margin is 25%. We'll assume 365 days in the year for calculations.
And we have industry averages to compare against.
We do for this industry. Inventory days are 53, receivables days are 23, payables days are 47, and the average current ratio is 1.43.
Right. So armed with all that, how do we diagnose Topple? Where do we start?
Let's calculate their cash operating cycle first, using those average figures and the sales purchases data to figure out their days ratios. When you run the numbers, Topple's inventory days are quite high, around 73 days. Their receivables days are about 31 days, and their payables days are roughly 28 days.
Okay, so their cycle is 73 plus 31 minus 28. That's 76 days. Whoops, let me recheck my math.
Close. Inventory days is average inventory, $495K, divided by cost of sales. Sales, $3.06, $1.25 margin equals $2.07 times 365. That's about 67 days. Receivables days, $306K, $3.06, $365 equals 31 days. Payables days, $230K, 3 metals and 3 in a K, 365 equals 28 days.
Okay, cost of sales, right. So 67 plus 31 minus 28, that gives us 70 days for Topple's operating cycle.
Exactly, 70 days. Now compare that to the industry average. The industry cycle is 53 plus 23 minus 47, which equals just 29 days.
Wow, 70 days versus 29 days. That's a huge difference, more than double.
It's massive, and that immediately tells you something is likely wrong. It almost certainly explains why they're forecasting such a large overdraft. Their cash is tied up for way longer than their competitors.
So why is their cycle so stretched? What are the specific problems?
Well, let's break it down by comparing their days to the industry. First, look at payables. Topple pays in 28 days, while the industry average is 47 days. They're paying their suppliers much, much faster.
Why would they do that? Especially as a new company.
Could be a couple of things. Maybe as a new firm, suppliers just aren't offering them generous credit terms yet. Or perhaps they are getting offered early payment discounts and they're taking them, even though it hurts their cash flow duration.
Okay, so fast payments is one issue. What about receivables?
Their receivables days are 31 compared to the industry's 23, so they're taking longer to collect cash from customers.
Maybe offering better terms to win business in their first year. Or maybe their credit control isn't quite up to scratch yet.
Both are plausible explanations for a new company, but the biggest single issue, look at inventory. Topolco's inventory days are 67 versus the industry average of 53. They're holding on to stock for 2 weeks longer than competitors, on average.
And that ties up a lot of cash.
A huge amount. Now, some of that might be unavoidable in year one, building up initial stock. Maybe sales haven't ramped up as fast as planned, but it flags a critical need for really tight inventory management systems going forward. That's the main driver of their long cycle.
Okay, cycle is long, driven mainly by inventory, but also faster payments and slower collections. What about the liquidity ratios, current and quick?
Let's calculate Topple's current ratio. Their current assets are receivables, $306K, plus inventory, $495K, which is $801K. Their current liabilities are payables, $230K, plus the overdraft, $500K, totaling $730K.
So $801K divided by $730K, that's about 1.10.
Right, 1.10. How does that compare?
The industry average was 1.43, so Topple's is quite a bit lower.
It is. And given that we know their inventory is slow-moving compared to the industry, that 1.10 might not actually be a comfortable buffer.
Which makes the quick ratio even more important here.
Exactly. Let's calculate it. Current assets minus inventory, $801K, $495K, is $306K. Divide that by current liabilities, $730K.
306K divided by 730K comes out to about 0.42.
0.42. So for every dollar of immediate liabilities, they only have 42 cents of liquid assets if you exclude inventory. We don't have an industry quick ratio to compare, but that number, combined with the slow inventory, really highlights their potential liquidity squeeze.
Yeah, that doesn't sound great. What about that sales to working capital ratio?
Okay, working capital is inventory $495K plus receivables $306K, payables $230K, which equals $571K. Their sales are $3.6 million, so 3.6 meals divided by $571K.
It's about 6.3, so they generate $6.30 of sales for every $1 in working capital.
Yeah.
Is that good or bad?
It's hard to say without comparison or trends. It might not seem super efficient, but again, first-year figures can be skewed. It's something to track going forward to see if they improve efficiency.
This case study really brings it all together. It shows how these different ratios paint a picture. So what's the bottom line for Topolco? What should they be focusing on?
Well, the analysis points to several areas. They desperately need to tackle that inventory turnover. They should review their payment terms. Are they paying suppliers too quickly? Could they negotiate better terms? Or is the cost of lost discounts too high? They also need to look hard at receivables collection. Can they tighten credit control without losing customers? And a really critical point about using benchmarks like industry averages.
Yeah.
Don't just assume the average is good. Maybe the whole industry is poorly managed.
Good point. So aim higher.
Ideally, yes. For long-term targets, try to benchmark against the best company in the sector, the leader, not just the average Joe. And that overdraft, it needs constant watching. They need to ensure they stay within limits and, crucially, have backup plans. What happens if the bank wants to reduce the facility? They need contingency funding options. It's all about being proactive.
Absolutely. Proactive management. Okay, we've covered a ton of ground today. It feels like the big takeaway is, well, understanding working capital isn't just for the finance nerds, right? It's fundamental. It's about understanding if a business is actually healthy, if it can survive, regardless of the profit number it prints.
Wow.
It's where the operational reality hits the financial statements.
That's a great way to put it. These concepts, these ratios, they let you look beyond the surface of financial reports. You can start to read between the lines, as they say. Understand the real cash dynamics, the flow that actually keeps the lights on and enables growth. It gives you a much richer picture than just looking at profit alone.
So, thinking about everything we've discussed, a final thought for everyone listening. Knowing this now, how might understanding these core working capital principles change the way you look at companies you follow, companies you invest in, or maybe even work for? Or perhaps, does it make you think any differently about managing your own cash flow, your personal finances, your spending habits day to day, something to mull over? Keep digging deeper on your own.